I've been asked to basically give a very brief assessment of the ECB's quantitative easing program. Before cracking on, I thought it would be necessary to briefly just recap on what led to QE. At the core of the Eurozone's economic malaise essentially lies a crisis of spending. I just wanted to explain a bit more what I mean by this. A rapid increase in private sector borrowing was not only the primary cause of the 2008 financial crisis, but also really helps explain the intensity of the ensuing recession. Too much private debt and poor prospects for economic growth meant that the private sector has been sacrificing spending either to pay down old loans or to save for when economic conditions start to pick up. New regulations and oversized balance sheets meant that the banking sector was generally unwilling to expand its lending. So together, this resulted in less private sector spending and investment. After bailing out the banks, government social expenditures increased, such as unemployment benefits, while tax revenues declined. So you had a massive budget deficit increase as well. So soon after, governments began tightening their belts under the guise of austerity and thus also restricted their spending. So basically what you've had is a massive restriction of spending from both the private sector and the public sector. The ECB eventually became concerned that spending would continue to decline and the associated contraction in aggregate demand would jeopardize the ECB's primary mandate of price stability. The ECB accordingly decided to implement quantitative easing, or QE. QE is where central banks issue newly created central bank reserves and use them to buy pre-existing financial assets, mainly government bonds. So the ECB and the national central banks have basically colluded will start purchasing up to 60 billion worth of financial securities from the secondary market every month from now until, well, from last March until March 2017. The general aim of QE is to increase spending in order to achieve price stability, defined as 2% increase in inflation. So given the size and strategic importance of QE, I think it's important to review whether QE is producing its desired effect and whether the evidence really corresponds to the theory. On the surface of any assessment, we should look at inflation. After Draghi's announcement of the launch of QE, we can see that inflation first took off a bit and then it slowed. Inflation emerged again from negative territory in October after Draghi's announcement of expanding QE. But oil prices may still be distorting the effect of QE on inflation, so let's look a bit deeper at the transmission mechanisms through which QE is supposed to work. To begin with, I wanted to look at the expectations channel. Large-scale asset purchases give investors an idea about the future course of action that the central bank is going to take. Buying considerable amount of long-term securities shows the market that the central bank is committed to keeping interest rates low in the future. So as Mr. Draghi has repeatedly emphasized, anchoring expectations to a stable and positive inflation rate is vital to the Eurozone's recovery, as Draghi says. So while inflation expectations experienced a rapid increase in the wake of the announcement of QE, short-term and medium-term expectations are now where they were in late 2014, prior to the program's announcement, while longer-term market expectations recently also hit an all-time low. That's what the graph up there should be showing. Another channel through which QE is supposed to work is the portfolio rebalancing channel. You basically substitute bonds with cash, and therefore banks at that point will have more incentive to lend to the private sector, basically households and companies. A few points I just wanted to make here. Firstly, prices were increasing and yields were already extremely low before QE was even announced. So this isn't to say that QE didn't have a rebalancing effect. It's more that its rebalancing effect might have been limited. Secondly, it's very likely that portfolio rebalancing had its biggest impact at the announcement of QE, but has since faded. But most importantly, I wanted to mention that yields have been declining since 2012, while banks have been flooded with reserves through other policy programs. But we did not see an increase in spending or in investment through any portfolio balancing mechanism. So why should we see one now? This brings us to the next channel, the bank lending channel. Injecting new central bank reserves, liquidity, into the banking system relieves balance sheet constraints, allowing banks to increase their lending to the economy. Here we can see that there has been a bit of a negligible increase in bank lending. Conditions are slowly, let me emphasize, slowly improving. But what I really wanted to emphasize is that conditions have been improving for an extremely long time. If you look at up there, loan growth has actually been increasing since 2014. It was negative, but it's been slowly increasing. So also, when we look at lending for real economy spending, last month consumer lending increased by 1.4%, and business lending actually declined by 0.55%. But the ECB also suggested that credit conditions have been better and they're gradually loosening and demand is increasing. But the fact still remains that real economy lending remains quite flat and it's well below what we need to see to trigger any increase in spending. And while the most recent ECB survey may suggest that a positive impact of QE on the real economy and that it has increased lending, a survey by Commerzbank completely contradicts this. The next transmission mechanism is the wealth channel. This suggests that higher asset prices also will essentially lead to an increase in demand as the wealthier get wealthier, and they should be induced to spend more due to more disposable income. But firstly, wealthy asset owners have a very low marginal propensity to consume. But also the composition of financial markets in other places that have conducted QE is very different, especially in the US and in England. A much lower proportion of European households hold financial assets, and the value of those assets tends to be much lower in the Eurozone as well. So along these lines, I just wanted to note that consumption has hardly increased since the onset of QE, and any increase has to be taken in consideration with a reduction in oil prices. Meanwhile, investment has remained extremely subdued. So unsurprisingly, official data suggests that retail prices have been disappointing of late, and many people are suggesting that the Eurozone's industrial sector is actually in a recession. The FISCAL channel. By pushing up sovereign bond prices, pulling down bond yields, QE lowers the interest rates that governments have to pay on their borrowing. But like I said before, we should note that borrowing costs were already extremely low when QE was announced. So what I should mention is that given recent global developments, borrowing costs may have been much higher had it not been for QE. Finally, I just wanted to mention the exports channel. By influencing yields and interest rates, QE devalues the currency, leading to an increase in exports. But let's remember that other central banks are conducting some form of monetary easing. Moreover, while exports may be cheaper, imports will also be more expensive. Here you can see that Eurozone net exports have only increased by about 3 billion in the last year. Finally, I just wanted to discuss the negative side effects of QE. By artificially increasing the price of financial assets, QE runs the risk of creating asset bubbles in the financial markets that could lead to further instability. Furthermore, QE increases inequality. I'm not really going to get into that, but we can discuss that later in question time. There's also a danger that monetary easing could keep up non-performing zombie so-called businesses afloat, which is maybe a very big danger in Italy at the moment. And finally, I just wanted to talk about the breaking up of smaller banks. The ECB notes that in 2014, the total number of credit institutions decreased to 5,614, down from 6,000 in 2013. So essentially, since 2008, there's been about a breakup of about 1,000 credit institutions. So what QE has really kind of benefited the bigger banks. Because they've managed to increase their profits, because they tend to hold more government bonds, and because they engage in more financial speculation. So they experience an increase in profits. Meanwhile, smaller banks don't really engage in any of financial speculation, so their profits have been reduced. And mainly because of regulation reforms, many small banks basically have had to basically default and close down. So while the point is there's also been a very devastating effect on QE for smaller banks that tend to lend for real economy investment to small and medium businesses, especially in Germany. So to conclude, I wanted to remind everyone that QE is ultimately aimed at increasing spending by encouraging the private sector to take on more debt, so that the cause of the financial crisis is ultimately treated as the primary solution. I also hope that people will leave here today from this presentation asking themselves whether many of the conditions that QE tries to create were already in place when QE was announced. Finally, at best, QE has helped generate some sluggish results. We can always argue that things could be worse. But if we are restricted to considering that the counterfactual is the only benefit of QE, I think every policymaker needs to be asking themselves, is there a better way forward?
Thank you, Frank.